start the panel by asking folks for their perspective on market conditions in the lower middle market for private equity. As much as I'm sure people would like to talk about market conditions in the stock market today, we'll try to avoid that topic unless people think it's relevant. So there's a lot of different aspects to the concept of market conditions: deal volume, valuations, availability of debt, any emerging trends that folks see. So I'd like to make it kind of an open-ended question and just ask people to describe from their perspective sort of what they're seeing in the lower middle market. And maybe start with Stephen and kind of work our way down this way.
Cheated. You're supposed to start down there. I'm supposed to have time to think about an answer. Look, I think we've had a number of years of pretty solid M&A, a pretty solid M&A environment, low interest rates, lots of capital available to pursue transactions, so valuations have been pretty solid. I think last year, if you read the trade rags, volume was probably a little bit down in the middle market last year. I think we saw some of that in our business, but in speaking with other colleagues, it was an okay M&A environment last year. Certainly not a bad one. So I am relatively optimistic about 2016. I don't think we're going to. I think we've probably plateaued in terms of all the favorable deal dynamics that we've seen in the marketplace. But I think what we're also seeing is perhaps, particularly for the private equity professionals out there, probably more rational valuations in the landscape to be seen. So generally speaking, I'm pretty okay with the M&A environment. I think we're it's not a robust marketplace, but certainly not bad.
Yeah, I think I broadly agree. Look, I mean, last year was actually a pretty good year for us. I think you had this sort of confluence of a lot of equity capital available, a lot of dry powder in the strategic community, and then widely available, inexpensive, flexible debt available, right? So that all added up to a really good year. I think we were up 86% year over year last year in our group. That said, it's slowing down, right? Like pitch activity is down. Things are, people are kind of looking at each other a little bit nervously, saying it's gonna be okay, right? It's gonna be okay. Here's what we're watching, right? Like the sort of upper part of the market is not in great shape, right? You talk to the large sponsors and they'll tell you it's a lot tougher to get deals done than it used to be, primarily from the debt side, right? That's where things have been, and that's largely being driven by kind of regulations for the large bank community. I think that has made it a lot harder to do sort of covenant-like, incredibly cheap, large debt financings. We haven't seen that come down to the middle market yet, right? Like recently made the rounds of kind of the debt providers we spend a lot of time with, banks, folks of that nature. They still want to put debt capital to work. It's still available for the middle market, and particularly for the lower middle market. And I think the reason I feel pretty good about it, and the reason I agree with you is, when you think about kind of that pressure, that regulatory pressure that is, kind of putting pressure on some of the larger transactions, it actually doesn't apply in the same way to smaller transactions. If anything, you'd argue these are the types of deals that the government wants banks to be doing. So I think I feel pretty good about that. Look, the X factor certainly is what's going on in the rest of the world. The equity markets do matter, so we're watching. So I'm maybe a little more cautious than you are, but it's slowing down. I think the fundamentals are still there, though, for lower middle market transactions.
I think the challenge trying to talk about market conditions when you're doing lower middle market deals is just the sample size is so small individually. So I'm not sure those of us up here are more qualified than those of you in the room to talk to it, but our own experience is that the market continued to be very strong in the second half of last year. We got 4 deals across the line in late November into early December, have 3 more that are teed up to close at the end of the first quarter. And echoing Eric's comment, there seems to be plenty of senior debt available. A couple of the mezz lenders that I know in the room are active and in the market and getting deals done. The one trend I think that we're starting to see is the emergence of sellers that are coming to market looking to time the top of the cycle. So I think that some of the business owners are starting to get the message, or starting to get nervous about what's going on in the stock market, what's going on in the global economy, And while from our view, M&A multiples and volume still remain strong in the lower middle market, a couple of these, one current client, one prospective client, explicitly told us the reason that they were talking with us at this point was they want to get a deal done before things fall apart in 2016. So that was a bit of a new signal from our standpoint, and I hope that they're off base because we want to continue doing deals.
So, I think from our perspective, 2015 was actually very strong, continuing the trend from 13, 14, 15. I think for middle market, 2016 is also going to be very strong, but it's very hard to isolate. I think it has to be pretty much sector specific. So what we see in the tech market, we have 4 deals in the market now, and very active. A lot of the large deals were done, and they are done with that, but the middle market are still there, and we think it's going to be very active for 2016. Healthcare specifically, medical devices, and not necessarily healthcare companies that are a little bit hurt by the stock market and valuation there that were kind of crippling, is very active as well. Food and beverage with focus on kind of health and the new products that are organic, etc. That's very, very active. So you see more trends towards that, and that's going to continue. I don't think that's going to change at all. We have another deal in the market which is very, it's a pretty large oil services, energy services company that we've been in the market with, almost sold it to 2 funds and basically investment committee. Our company is performing wonderful. The revenues went up every year, more than, I would say, 40% year over year, even this year. But the investment committee couldn't kind of still decide on writing the check in these oil prices. So I think that's kind of more industry sector specific. Debt markets, we think in middle market, lower middle market are very active, very open, still very flexible. And the larger deals, I think, I was talking to a 1.5 billion family office in the real estate market. The spreads are higher, maybe 100 basis points more. But other than that, they're still doing a lot of deals, and I think that is not going to be an issue for 2016 unless something happens.
So it sounds to me like people see sort of a soft landing happening at the moment with maybe some degree of people kind of holding their breath, waiting to see what happens next, and a sense that there may be more sort of downside potential than upside potential in the market in 2016. Is that a fair assessment of what folks are seeing?
Yeah, look, we've had a pretty nice run in terms of our economy. And I think if you are looking to deploy capital, putting myself in the shoes of a private equity firm or lender, you've got to be a bit more cautious about what you're doing today. I'm not surprised to hear that comment about an oil service business in the marketplace. You got to swallow hard to make that investment, I would think, because you've got headline risk. Right? If you're the investment, you're on that investment committee and you make that deal and it doesn't work out. People are going to say, well, geez, didn't you read the newspaper?
Yep, that's right.
So I think people are just being more cautious.
Yep.
So that's going to impact perhaps diligence. It's going to impact in terms of diligence might take a little bit longer. People are going to ask more questions. But I still think it's a marketplace where there's a lot of capital and people are still, they're forward leaning. They want to get a deal done. They're looking to do transactions both on the private equity side and the strategics have been, they've been active as well.
I think it's kind of like sector specific, maybe too, maybe more so than in other years, right? Like energy clearly out of favor. In my own world, defense is very in favor, right? So folks are trying to put capital to work in defense right now. And I think maybe more than in other years, it's about pick your places. I think broadly speaking, there's some folks who are very bullish on kind of North American industrial economy. Low oil could be a good thing for, right? So it's about deploying your capital intelligently.
Okay, great. Well, so now I'd like to sort of shift gears from the macro picture to more of a micro perspective. And in particular, for this panel, I really wanted to get the perspective of investment bankers on what really differentiates private equity firms in the deal process, as opposed to what they put on their websites. And I was on a panel last week where there was was a friendly debate between whether industry expertise or basically sort of behavior during the deal process is more important as a differentiator. My perspective is that I think behavior matters a lot. I'm not saying that industry expertise doesn't. But so I just wanted to sort of start with getting your perspective on what behaviors from potential private equity buyers do you appreciate in a process, and what behaviors have you seen that you don't especially appreciate? And maybe just to mix it up a little bit, start with Andy, if that's
Sure.
okay.
Yeah, I guess to your point, I think the industry specialization, when we're putting together a prospect list for a transaction, industry specialization certainly gets you on the list. And then our familiarity with your past behavior can cut in your favor or against it. I'd say more often, to the extent that we're factoring in known behavior, it's if we've had a negative experience. When you were talking to me about that earlier, Steve, I was thinking of a recent transaction where an unnamed private equity sponsor put in an IOI that was probably it was the largest valuation range, got the client all excited, and called them back to invite them to a management meeting. 4 days go by with no return to any of my messages, and when they finally called back, they said, well, we just signed 2 LOIs last week, so we really don't want to chase your deal. And it's clear that their approach to that particular transaction was just, throwing IOIs out to see what sticks, and then doing the work to see if they wanted to play or not. Needless to say, we won't be circling back to them anytime soon. So what we appreciate is the people that put the work into reviewing the materials, have some seriousness of purpose when they get to the bidding stage, and move forward from there. To the industry specialization, that certainly plays a role, because it gives us familiarity with the sponsors that know the sector, that know the macro trends in the sector, and we have confidence that by the time they get deep into conversations with us, they understand the pros and cons of the opportunity, and they're not going to be surprised by what Steve called the headline risk about any of the industry factors that might impact the opportunity.
Great. Eric, do you want to?
Yeah, sure. So I think of it as kind of before a deal happens, kind of up to IOI, and then kind of LOI, right? So before a deal happens, totally agree. We think about how people have behaved in the past. Industry specialization matters to us. I'd love to say we're perfect about covering the thousands of sponsors out there and knowing what they're about, but it's much easier to remember that sponsor is really good at this. So we do think about that. I think the reason it's important to you guys is look, yes, to be included in the auction processes, for sure. You want to make sure we think of you for that. But where we can be really helpful to you, right, is the one-offs where we can help you avoid an auction process, right? And it does happen. Whether that's an owner, we've got one right now where the owner just said, I don't want to run a broad auction for a lot of reasons. I want you to bring me a couple of quality guys and I'll pick from that. You want to be on that list, right? So that's important. Or if a transaction falls apart and we have an opportunity to bring it to just a couple people to just get a deal done, those can be where you can kind of achieve real value, and you want us to really understand who you are so that we can come to you. For sure, the easiest way to do that, right, is to give us work, right? But even if you can't do that, I think it's just clarity of message and staying front of mind with us is really important. I think when you get into the IOI phase, things, I totally agree. Like, do your homework. Don't just throw out IOIs. If you tell me you're going to pay somewhere between $1 and $1 billion for this company, it's not a particularly useful piece of paper to me, right? So show that you've done a little bit of work up front and you really are interested in this. And then when you sort of head into the LOI phase, do the homework. Show that you've worked. Bring your folks out so that the client can see that you're really serious about this transaction and you're doing your homework. Go into the data room, and that doesn't mean, as happened to me one time, that you have an analyst set an alarm for 9:07 a.m. to log in every single day at exactly the same time. It means get in there, read the stuff, show you've done the work, and then listen when we try and give you guidance about what's important in an LOI, right? It usually means it's come from our client, and it's what they want to see. If you can incorporate that in, it really differentiates you. Usually some of the things that we, and I would say everyone in this room, might find very silly, as important as part of an LOI, might be very important to this particular family for whatever reason. And if you can listen to that, I think it really differentiates you during a process. So.
Okay. Stephen?
Yeah, really not much to add there. I will say, just because all those things are right on point, a pet peeve of mine is we get to the point where we've invited you in for a management presentation, and you take that meeting, and you're one of, look, we're only going to bring in 5 to 8 parties, right, in most processes. And you haven't, the private equity group hasn't done their homework. It's clear, based on some of the questions, that maybe some of the members of the team that maybe weren't the people that I was interfacing with when we were kind of selecting groups. And that's a reflection, not only on the firm, the private equity firm, but that becomes a reflection now on me, right? Because after that meeting, if that doesn't go well, you're asking questions that were on page 1 of the information memorandum. I'm going to remember that, because my client's going to. I've had this in certain situations. The client looks to me and says, "What was up with that?" I've spent now 4 hours with that group, and they clearly didn't understand this business.
Yeah.
So that's a pet peeve I have. Okay, come to those meetings prepared. The groups that I like, when they, I've had a group that's come prepared. They had an outside consulting firm do a basic market study to assess market size. I mean, within the first 15 minutes, that group became the lead bidder, even though they weren't the highest bidder, because the management team said, "Wow, those guys." It demonstrates that they're really going to add value, right? Because everyone, if you look at all the private equity websites, everyone's a value-added partner. Right? They demonstrated it in that meeting. So don't take for granted how important that face time is with the potential buyer. Potential seller.
Yeah, I'm glad to hear you say that, Steve. And I was in a bank meeting recently where there were a number of banks that were sort of competing for the business, and the quality of the questions varied, somewhat widely amongst the different banks, and it really had a dramatic impact on our view of who we would like to work with, and more so than a quarter point of margin. Daniela, would you like to weigh in?
Yes. So when I run M&A processes, it's very different. I usually don't do an auction or a bid process, and I feel like the best way is to go both to strategic and private equity and prepare in a process less formal. It's like a semi-formal process. So, at some point we are setting 4 or 5 term sheets against one another. But before we get to that stage, we want to get to know better the potential players, set some strategics so that we get the best valuations for the company. But also I feel, especially if my CEO or the company owner stays in the deal, it's very important who we are selling to. If he's keeping 40%, 30% of the equity, the behavior is going to be a very important part. And, in a lot of our transaction, the owner keeps 30, 40% of the equity. The second bite at the apple is going to be more substantial or potentially more substantial. And it's very important for us to pair him with someone that will be able to really bring in those capabilities that they're missing on their own. So we do spend a lot of time basically matchmaking in a very, very long process. So at the time we get LOI, I know that they understand the deal, they understand the company, they know the challenges, and we really get to know them. And then together with the CEO, we decide who we want to ask for LOI from. So I usually won't get these LOI because we're not wasting time on that. And I think also once you build the transaction in a way that you tailor it to a strategic, you will get the best valuation, or you tailor it to a private equity group with, there is an add-on to their portfolio company. You really understand the synergies. I will get the best value there, and then I will basically bet them against 2 or 3 other players that have been running along on the deal. And basically, I think that's how you get to a closing in a better way.
Okay, great.
For our deal, at least.
So just one follow-up question that I'll just throw out to people. I'm just wondering, is the answer to this question of how you differentiate between different PE firms in a process, is that answer any different for your clients? Do they bring a different perspective, or is it pretty much the same answer for a seller as it is for the banker generally? And it may be the same. I'm just.
No, I'll throw one thing out. I do think, for clients, this is their baby, or this is stating the obvious, so apologies, but there is sort of a respect element too. I have seen folks, we're all busy, and I totally get it, But if somebody's on their BlackBerry or taking phone calls in the middle of management presentations and all the time, it leaves the impression that whatever else they're doing is more important than this transaction, which is, you know, for a privately held business, this is the most important transaction financially anyway that they will take in their life probably. Like they do appreciate folks being really, really focused on it. So, you know, just sort of showing respect, I think, does matter. I don't know if that's what you were going
Yeah,
for.
no,
but-
that makes a lot of sense.
I'll even take it a step further. Most private business owners, they don't really understand private equity firms, or their understanding of private equity firms isn't really a positive one, all right? Because a lot of the business owners, look, even though private equity has been around as an industry for many, many years, lots of private business owners think of private equity as, okay, they're gonna buy my business, they're gonna lever it up, they're gonna fire all my people, and then they're gonna, you know, they're gonna wreck the company. That's the impression that a lot of business owners have. And they go into those management meetings, you know, no matter how much prepping, you know, I can do as a banker to help them understand how they're gonna be value added and here are some great stories, that's their bias. So you as a private equity professional need to be mindful of that and don't be the, you know, if you come in with the blue blazer and sports jacket and, yeah, don't dress the way you are now. No, but try to get down to their level and try to understand and respect that they've built a nice business here. Ask questions, but do it in a respectful manner because they're trying to figure out what this private equity thing is about, and don't feed into their initial impressions that okay, this is really just a slash and burn type of investment opportunity for you.
So earning their trust is something that people should take very seriously and be thoughtful about. It sounds like.
Particularly as you get further lower and lower down the middle market, into the middle market, I think that's critical.
Yep.
I think in addition to earning the trust, picking up on your point, it's helping us to educate the client about what's involved in working with a private equity sponsor going forward. Many of our clients are often agnostic about whether they want to sell to a strategic or a private equity investor. So we'll certainly do what we can to get them up to speed on the differences. But to your point, I mean, they'll often start the rollover conversation by telling us, well, how about we roll over 5% of the equity? And you know what they're really thinking about is just an exit. And as we introduce them to groups that we've worked with before that know their industry, having the conversations to understand the reason that they may want to stay involved, you know, at a more reasonable role, at the typical expected level for rollover and what they can benefit from that, you know, helps us to educate them about the process and helps to flush out what they're really looking for from the transaction.
Okay, great.
I have one more thing.
Yep, sure.
So I think in one of my transactions, you know, it's private equity from a bulge bracket investment bank, you know, they're like $5 billion, very large fund, but still very, you know, intimate people, and they know how to manage the relationship. And I think part of what they've won my client with is they've introduced us to maybe 3 or 4 CEOs that they're working with, and each one of these CEOs has, you know, done 5 or 6 deals with them. That means they're good. So a lot of times you find a CEO after he's done the deal and then, you know, he understands, well, it's not really what I thought, and kind of eyes opening, the relationship didn't work out well. But when you have a CEO that came to the same sponsor time and time again and they've made a lot of money together, that's very convincing, I think, to the entrepreneur, and basically helps to convince them to work with that sponsor.
Okay, great. So I think the next question comes down to, I think a lot of private equity firms talk about looking for bargains in the lower middle market versus larger companies. And at the same time, in my experience, I've seen a lot of PE firms turn down deals for reasons that are very common in the lower middle market. Things like customer concentration, lack of depth of the management team, that sort of thing. And they're legitimate reasons. But it sort of begs the question of, are there really bargains in the lower middle market? Or does buying a company at a sub 6 times multiple require either a lot of heavy lifting or simply a higher tolerance for risk? I wanted to get people's perspectives on that, and maybe some examples, if you have any, of a deal that you've gotten done at a sub-6 multiple, and how and why it got done at that kind of a multiple. Okay, go ahead.
So I sold at the beginning of the year, sorry to tell you, because to a sponsor actually that is part of Opus, that I met for a long time. We've had discussions. We actually almost sold the same company to another sponsor, private equity fund that had a portfolio company that was a strategic fit. It didn't work out because they couldn't get the financing in place. And there was, the issue was customer concentration. 75% was by one customer. It's a very large customer in the medical device space, but still it was big concentration, one owner, wonderful management team, but still, I thought it was a very good opportunity, and a lot of people had issues with it. So that deal didn't come through. We've been in touch, and basically one sponsor here was able to get that because of the issue of customer concentration. It wasn't that lower than 0.6, but still it's a very good deal. They need to deal with it, but they were able to overcome that and see kind of behind that the potential is really great.
Okay.
I totally agree. I think customer concentration comes up time and time again in lower middle market transactions, and I get it. I know it makes getting debt financing harder, but I do think if you get your arms around customer concentration, that is the key to getting deals done. We did a deal. I come into this a lot, just also industry-wise. I had a sponsor call me and say, Eric, they only sell to the U.S. government. Like, that's just one customer. I said, well, they make missile parts. I'm not sure we want them selling to anybody else. But almost any lower middle market transaction, you're gonna kind of come across this sort of concentration issue. And I think if you get your arms around it, that also shows to the business owner, to kind of that respect theme, that you've taken the time to understand their business. There's always a reason why there's customer, right? They built the business up selling stuff to Boeing or whatever. They're really, really good. Boeing loves them. That's what built the business. If you can get your arms around that, I think it shows that you really understand the business. And yeah, sometimes it can lead to getting kind of a bargain. I think sub-6 is optimistic, at least in the industries I traffic in, but it certainly can maybe get you below what kind of comps might otherwise point to.
I think that the customer concentration issue can become positive in some ways. Circling back to the earlier topic of industry specialization, one of the deals that we have in the market right now is a company that provides a particular outsourced business service to the car rental agencies. And clearly there's the big three in that industry with Hertz, Avis, and Enterprise owning a number of sub-brands and controlling 95% of the market or more. And a couple of the groups that we're having management meetings with right now have some prior experience in the sector, and one in particular has an operating partner who knows C-level executives at two of those three customers, and where our company is interacting at a regional level as it's growing out its pipeline, that entree to the C-suite, I think, really gives that particular sponsor the inside track on that deal.
Okay. So we've talked a lot about customer concentration and PE firms occasionally getting their arms around it. What I'm wondering is, sometimes there's a fine line, I think, between being insightful and simply rationalizing a poor decision. And I'm wondering, how have you seen private equity firms get comfortable with customer concentration, where you've seen that happen?
Well, I'll take that. We had a situation where there was customer concentration with one vendor, one guy represented probably about 60% of the business, but it was a large corporation, and what you really had is you had 60% customer concentration, but you had 4 or 5 different decision makers that were in different divisions within that customer. And there are a lot of parties that looked at that situation just couldn't get comfortable with it because they saw that this entity was 60%. You had to have the willingness to dig in, look a little bit deeper, understand the contracts, understand how the decision process was made to get your arms around it. And I'd say that in that process you lost 60% of the buyers that we approached just on that customer concentration issue alone. So, look, if you're gonna find a deal at sub-market value, there's hair on the deal, right? Someone's gonna need to roll up the sleeves and figure it out. So I'm sitting here kind of thinking about, do you get what you pay for then, right? Because a lot of deals are less than market value because, you know what, there's work to be done, right? It's customer concentration aside, oftentimes a lot of these smaller companies, look, you may not have the best management team in place, right? To get that business from whatever, 25 million revenues to 50 to 75, that talent may not be resident there. So you need to think about replacing that executive, maybe the CFO, systems often aren't in place. So, there's an investment required, and I think certain firms may fall in love with the fact that, okay, yeah, I bought that business 4 times, but you be prepared to spend some time and effort rolling up the sleeves and professionalizing that organization. So, yeah, now look, I've seen many stories where that's worked out well and they sell that business for 8 times within a 3 to 5 year period because the bones were good. Right. You just needed to have some vision.
It was borderline on to tell you about your own business, so apologies. But look, I mean, isn't it about understanding the risk you're taking, right? Really spending time understanding what it is, right? If it's customer concentration, what kind of concentration is it? Is it I only make one product and there's 8,000 other people who can make that product and I could lose my contract any day? That's kind of scary, right? But if I'm one of the only people in the world capable of making this, if I have extreme concentration, maybe I can get comfortable that while there might be risk to that long term, in the near term there's nobody else who can fill those shoes. And maybe my job as the next owner is to diversify the company and diversify that risk away. And I would agree with you on some of those other risks, right? It's understanding, hey, I've got a management issue. I can really understand that though, and I've got a plan for that going forward. That is where I have no problem explaining to my sellers that they're going to have to accept a lower price because of the inherent flaws in the business. And I think it's incumbent on buyers to really put a box around what the risk they're taking is and price it accordingly.
And picking up on that point, tying that into the current state of the market that we talked about earlier, we've had a couple of clients that we were in the market with now that we pointed out some of those management team shortcomings and talked to them about what might need to be done over the next couple of years to professionalize the management team in order to improve the multiple they might get for the business. Their ultimate decision was that, again, where the state of the market is right now and valuation's fairly high, their thought was they may just tread water on valuation by improving the company's performance, but then selling into a down market at a lower valuation because of macro factors down the line, and ultimately they chose to go to market now.
Okay. Thanks everyone for coming, and please join me in thanking the panel. Great job, guys.